He was the most successful investor of the 20th century. Time magazine called him one of the most influential people on the planet. His net worth is tens of billions of dollars. I am talking about Warren Buffett. In this video, I want to share the main principles I took from his speeches and from his life. These ideas shaped how I think about work, money, success, and risk. I am not trying to copy his life, but I do want to copy his thinking. I will talk in the first person, because these are rules I try to apply to myself, not quotes for a poster. First, passion. Buffett says the biggest luxury in his life is doing what he loves every day with people he likes. That is how he defines success. Not houses and yachts, but waking up genuinely excited about his work. I try to look at my own career the same way. If I had complete financial freedom and never had to work for money again, what would I still want to do? What kind of work would I choose if salary did not matter? That is the direction I want to move toward. Sometimes I have to take jobs just to pay the bills, but I do not want to stop searching for work. I would happily do even if I were already rich. Chasing more money just for a bigger number is a trap. If I think happiness starts only when my income doubles, I will accept jobs I hate, compromise my values, and agree to deals that feel wrong. Later, I will not be proud of those choices. One of my core rules is simple. I want to find work I enjoy and work hard at it, instead of sacrificing my whole life for a bigger balance on a screen. Another principle is about heroes. Buffett insists it is crucial to pick the right people to admire. We cannot choose our parents, but we can choose whose example we follow. I like this exercise. Imagine I could buy 10% of the future earnings of any person I know. Whose 10% would I buy? It is rarely the person who is just the smartest or the most talented. It is usually someone with strong character and good habits. Optimistic, but realistic, generous, responsible, reliable, someone who treats people well and keeps promises. Those are the qualities that compound over decades. Then I turn the exercise around. I picture a person whose life I definitely do not want. I ask what exactly makes them a bad role model. Selfishness, arrogance, unfairness, constant complaining, blaming others. Then I ask, why would I allow those traits to live inside me? If they irritate me in other people, why tolerate them in myself? Those are the habits I want to cut out early, before they harden into my personality. Buffett also talks very openly about love. The biggest lesson he took from his father was the power of unconditional love. If a child grows up knowing there is at least one person who will always be on their side, it gives them huge inner strength. When I think about my own closest people, I remember that in old age I will not measure my success only by my bank account. I will measure it by how many people I love and how many genuinely love me back, not for what I can buy, but for who I am. His simple test is this. In a crisis, who would hide you if they had to risk something for you? If by the time I am old, many people would hide me, I had a successful life. If I have money, but nobody would do that, I failed where it matters. From there, Buffett returns again and again to one theme: investing in yourself. He repeats that the best investment anyone can make is in their own abilities. Skills do not get taxed, cannot be confiscated, and no bear market can wipe them out. If I want to increase my value in the market, one of the simplest multipliers is communication. If I can explain my ideas clearly in writing and out loud, I immediately become more valuable. He jokes that if you cannot communicate, it is like winking at a girl in the dark. You know what you are doing, but nobody else does. For me, this means I cannot hide behind a screen forever. I need to learn to speak, to write, to sell my ideas, to ask good questions, to negotiate, to listen. These are learnable skills. He himself was terrified of public speaking when he was young. He even paid for a course and then was too scared to attend. Later he forced himself to try again, finished the course, and says it changed his life more than any university degree. That is a pretty strong signal about where I should put my effort. Character matters just as much. When he hires people, he looks for three qualities: intelligence, energy, and integrity. If someone lacks integrity, the other two will destroy you. If a person is dishonest, you would prefer them to be slow and stupid, not smart and energetic. Intelligence and energy are partly given by nature, but integrity is a choice. I cannot change my raw IQ or my height, but I can decide to be honest, to keep my word, not to cheat. If I combine that with the brain and energy I already have, the long-term result can be incredible. If I do not, a big part of my potential will be wasted. He uses another simple metaphor about health. Imagine someone gave you one car for your entire life. No upgrades, no replacements. You would treat that car with extreme care. Yet we all get only one body and one brain, and many people treat them worse than their car. They sleep too little, eat garbage, abuse substances, never move, never train their attention. At 50, they suddenly decide to start taking care of themselves. It is better late than never, but the earlier I treat my body and mind as my main productive asset, the more years I will have at full power. Now to investing principles. Buffett is very honest about his limits. There are many things he does not understand, and he simply stays away from them. He draws a circle around what he truly understands and stays inside that circle. It does not mean he knows every detail of every product. It means he understands the long-term economics of a business, its competitive advantages, and what might destroy them over the next decade or two. I want the same discipline. I do not need an opinion about every stock or every crypto token. It is fine to say, I do not understand this, and move on. I would rather focus on areas where I understand how the money is made. Connected to this is the idea of the moat. Capitalism is a system where people constantly attack your castle. If you sell something profitable, competitors will appear. A great business is like a castle with a wide, deep moat around it. That moat can be brand, network effects, patents, cost advantage, unique location, or talent. The key is that it is hard for competitors to cross. A sustainable competitive advantage plus decent management can produce value for decades. When I look at a company, I ask, what is the moat here, and why will it still matter 10 years from now? Another classic concept is the margin of safety. You would not drive a truck that weighs almost 10,000 pounds over a bridge with a 10,000 limit. You would choose a stronger bridge. Investing is the same. I do not want to buy something that only works if everything goes perfectly. I want room for mistakes, bad luck, and surprises. That can mean buying at a discount to intrinsic value, avoiding too much debt, and not putting everything into a single fragile bet. It is better to be slightly conservative and stay in the game than to stand on the edge trying to squeeze out the last bit of return. There is also a powerful thought experiment about human capital. Imagine Buffett walks up and says, he wants to buy 10% of my financial future and asks how much I would charge. Whatever number I name implies the total value of my human capital. For most people, if they think seriously, that number is very large. The point is that my main financial asset is not my stocks, my house, or my cash. My main asset is my ability to earn, to think, and to create value over my lifetime. That means the first priority in my portfolio is myself, my skills, my habits, my integrity, my health. From this angle, one of the biggest enemies of a young person is bad consumer debt, especially high-interest credit cards. You cannot move forward financially if you keep borrowing at high rates. If I load up a card and pay only minimums, I am basically working for the bank. It is much easier to stay out of trouble than to get out of trouble. So his advice is simple. If I cannot afford something, I should not buy it on credit. I should focus on building my earning power and investments so that one day I can pay in full. The same logic applies to education and lifestyle. There is a big illusion that the more expensive the school, the more magical the result. In practice, the difference between a very expensive degree and a strong, cheaper public university is often tiny. Real education is mostly self-education. Today, I can get world-class lectures on almost any topic online for free or for a small fee. Before taking on huge student loans, I should ask whether this specific program really increases my earning power enough to justify the debt. In many fields, the answer is no. I would rather keep costs low, learn aggressively on my own, and invest the difference into my future self. I also try to live slightly below my means, no matter how small my income is. That small positive gap between earnings and spending is what slowly turns into capital. When it comes to actual investing, Buffett's message is surprisingly simple. For most people in the United States and Europe, the most realistic way to build wealth is not to hunt for the next miracle stock or complex fund. It is to regularly buy a cheap, broad index fund that owns a diversified set of businesses and hold it for decades. He even put this into his own will. Most of the money he leaves to his wife should go into a low-cost S&P 500 index fund. Not a secret hedge fund. Just broad ownership of productive businesses at low cost. To show why, he likes to go back to 1942 during the Second World War. Imagine putting $10,000 into a broad American stock index and simply reinvesting dividends, doing nothing else. By old age, that lazy, boring decision would have grown into tens of millions of dollars. The exact number is less important than the principle. A growing economy plus compound interest is a massive tailwind for a patient investor. Compare that to buying gold at the same time. Gold would have grown much less because it produces nothing. That is the core difference between productive assets, like companies, and non-productive assets, like metal. Businesses earn money, reinvest, and grow. Gold just sits there and shines. This is why he says that the longer you hold a diversified group of good stocks, the less risky they become. With long-term bonds or cash, it can be the opposite, especially during inflation. You can survive a few years of low returns. What you cannot survive is losing your purchasing power permanently. People often ask whether they should wait for the perfect moment to enter the market. They see record highs, then crashes, and want someone to call the bottom. The truth is that nobody knows. If I decide to be a long-term owner of businesses through an index fund, I accept that prices will move up and down. When the market is down and I am still saving, lower prices are actually good for me because I am buying more future earnings per dollar. What matters is where those businesses will be 10 or 20 years from now, not the next 10 days. On paper, this sounds easy, but emotionally, it is hard. Most people want fast results and constant excitement. That is why casinos, sports betting, and speculative trading are so attractive. The idea of putting money into an index fund and leaving it there for decades feels boring and scary. This is why temperament matters more than IQ in investing. You do not need to be a genius. You need discipline. You need the ability to watch your portfolio fall by 30 or 50% and not panic, not sell everything at the bottom, and not start doing stupid things just because everyone else is. If you know you cannot emotionally handle this, it might be better to use safer vehicles and accept lower returns than to live in constant fear and regret. Another theme he returns to is risk and leverage. He tells stories of brilliant funds run by people with extreme intelligence who still blew up because they used too much borrowed money and took risks they did not need. They risked what they needed in order to gain what they did not really need. That is madness. Some games should never be played, no matter how attractive the payoff looks. You can recover from a mediocre return. You cannot recover from going to zero. So I try to avoid strategies that depend on heavy leverage, fragile derivatives, or bets where one shock can wipe out years of work. A simple rule helps. Never risk what you truly need for something you do not need. Cash and inflation fit into this picture too. Cash is like oxygen. You need enough to survive and to sleep at night. But over long periods, cash is a terrible investment. It earns little and loses purchasing power as prices rise. Once I have a sensible emergency fund, extra cash should slowly be converted into productive assets, businesses, equity funds, maybe some real estate. Governments can create more units of currency very easily. They cannot as easily create more truly productive assets. Over time, almost every currency in history has lost purchasing power. That is why owning pieces of real businesses is usually a better long-term defense against inflation than just hoarding money. All of this could sound like I worship investing and ignore everything else. I do not. One of the central lessons from Buffett is that money is only one part of a good life. He constantly emphasizes that his biggest successes are not specific trades, but the work he does, the people he works with, his family, and the fact that he spends his days doing something he genuinely enjoys. He warns against postponing life, as if one day in the future everything will suddenly be great. If I hate my work for 40 years just for theoretical freedom later, I may discover that I traded away the best part of my life. He also pays huge attention to the people around you. Over time, we become more like our environment. That is especially true for a life partner. Choosing someone I admire and respect, who challenges me to grow, will pull me in a better direction. The same applies to friends and colleagues. If I spend my time with people who constantly complain and chase easy money, it will be hard to stay patient and rational. If I spend my time with people who work hard, think clearly, and treat others well, that becomes my new normal. He is also very open about his own mistakes. He has had terrible investments and missed amazing opportunities. The key is that he admits them, studies them, and moves on. The most painful errors are often not the things he bought that went bad, but the great opportunities he understood and still did not act on. I feel the same. Many of my most painful memories are chances I did not take when I knew better. So discipline works both ways. Discipline to avoid stupid risks, and discipline to act when the odds are clearly in my favor. Above everything, he says, the best investment is in yourself. That includes building skills, especially communication, learning how to write and speak clearly, how to persuade without manipulation, how to listen and handle disagreement. Degrees are useful, but they are not magic. What really compounds is the combination of useful skills, good habits, and rational behavior over a lifetime. No one can tax away my ability to solve problems, think independently, communicate clearly, and work well with others. So when I put this all together, my philosophy looks like this. I treat my own skills, habits, and health as my primary asset. I try to live below my means and avoid dangerous debt. I see education as a tool, not a luxury brand. For the core of my wealth, I prefer simple, low-cost index funds over complicated products. If I choose individual businesses, I stay within my circle of competence and focus on a small number of high-quality companies bought with a margin of safety. I respect risk, avoid leverage, and never risk what I truly need. I accept volatility as the price of long-term ownership and work on my temperament, patience, and rationality. It is not glamorous and it does not promise quick riches. But over time, this quiet way of thinking lets compound interest, human progress, and time do most of the work, while I focus on becoming the kind of person who can actually enjoy the results. I do not need to be as rich as Warren Buffett to consider that a successful life. Thanks for watching. Please like if you found this helpful, leave a comment, be sure to subscribe, and share this video. You can find useful links in the video or channel description. See you soon.